Hey everyone, today's Wednesday, October 28th. We're going to do the video today. We usually do it on Fridays, but we just came out of watching the Fed meeting and Powell's press conference, and we've got a few things to say, not too much. What it's really doing is we're confirming our playbook, our outlook for the year has really has really been dialed in. It's been highly accurate. As you know, we've been saying all year that we thought the market would be upward biased, but that the first half of the year would be corrective in nature. We had a more than 20% drawdown correction, drop in stocks by over 20%, bottoming, I believe it was April 7th, April 9th. And then we've had one of the more vicious rallies we've ever seen with the S&P 500 up almost 45%. I think it's 43% off the April 7th low. And NASDAQ even better, and since April, it's up 55%. So that's NASDAQ 100. So just an absolutely bullish market. This is what we saw coming when we said we're getting more bullish. I've rarely seen an economic landscape shape up where interest rates were going, what the Fed was going to do, what corporate earnings were going to do, a build out of a major sector of technology, the consumer in very good shape, but corporate America in even better shape. Yeah, all the stars were aligned. We're going to say how we think what's going to happen here for the next 8 weeks of the year. We are now the last 2 days of October, so we are now 1/3 or 1 month into the fourth quarter. Things are going to go very quick over the next 8 weeks. But let's kind of go through our notes here today. So we got we said 2 to 3 Fed cuts all year long. Sometime in July, I basically came out and said, we think it's going to be 3. We've now had 2. We had 1 in September last month. We just had another quarter point today. That's on top of the 1 percentage point, 4 cuts last year. And I do think they go again in December. Right now, there's a big debate. Does the Fed need to go or not? Because inflation bottomed in April at 2.3% on the CPI. It's been creeping up just around 3%. Core CPI inflation. So that would mean that the Fed should probably sit tight and not cut rates anymore. But we've got a bifurcated market in here, bifurcated economy, where you've basically got the corporate side is very strong, but the consumer is weakening. And so you kind of have to view it in two sides. The corporate America does not need the Fed cuts. Consumer America does. So, and we do it by just looking at certain sectors of the market. So, right, the technology sector that's really doing most of the heavy lifting this year and the gains in our portfolios anyway, they're all business to business. You know, Microsoft is buying chips from NVIDIA, Meta is buying this from that company. Corporate America, the businesses are buying from each other, but the consumer is still struggling a little bit. The wealthy are doing well because of the stock market effect, where they feel wealthy and they can still buy. But if you're just living on an income, it's not been as easy. And so while the Microsoft up 28%, you've got NVIDIA up 54%, you got one of our top holdings, Palantir, up 160% in the 10 months of the year. Meanwhile, you've got Home Depot and Costco, consumer businesses, they're down about 1%. And another way to look at it is the S&P 500 that's cap weighted, which means 1/3 is now in the Mag 7 tech stocks. That is up 17% year to date, but the RSP, which is the equal weight, it gives as much weight to Home Depot as it does to NVIDIA, that is actually only up 10%, so a 7 percentage point lag, and that's where you begin to see the everyday consumer. So we think the Fed should cut rates, get mortgages down, car loans down, student loans down, small business loans down, and that will kind of help stabilize, you know, the other 490 stocks in the S&P that are kind of just doing so. Interesting today, Powell did something. We've been saying all year we didn't think that the tariffs were inflationary, and the Fed was kind of arguing the other way. They now in the press conference said, you know, we now view tariffs as just a one-time, he didn't say the word tax, but a one-time increase in prices, and they'll see. So it's always nice when we say something ahead of the Fed and a different way of looking at things, and then the authorities out there, the Federal Reserve in this case, come back and they see our view. So that was pretty satisfying in here. So how do we see the remainder of the year playing out? Basically through October, with the markets up 17% for the S&P 500, the NASDAQ is up 24%. This is the 3rd great year. We played it really well. What I see happening starting in November, maybe the first week or two, is I would like to see a pullback from these elevated levels, a pullback of anywhere between 3 and 8%. Let's just throw 5% on the table. We touched 6,900 on the S&P, so I think we can get a 5% pullback in the next couple of weeks. It is just corrective in nature. Wring out some of the froth, some of the weak hands. We're sitting on a lot of cash just that keeps coming in. We're going to put that money into the market. And then after, I would say from the middle of November on, we should get a good rip higher into the end of the year or into the middle of January. For 2026, we're sort of keeping our playbook and our outlook under wraps right now. This week I was designing the new rebalance, the new allocation that we're going to go into 2026 for, both individual stocks and then the various sectors that we're going to be in. But we're going to wait till we get those positioned right now. But I'll just say short that 2026 is going to be a little more choppier than I thought it was going to be. So we've got 2023, 24, and now 25, all good years. 2026 might be more of what we saw at the beginning of this year, but again, we're going to hold off on that. Lastly, there has been a tremendous amount of debate out there in the market of are we in a bubble or not? And I've been saying the whole time, I don't think we're in a bubble. I don't even think we're close to a bubble. But most of the pundits that you see on TV weren't around in the 90s. I hate to say it, but I'm old enough to not only be around, but also have significant money invested in the market. And you have to really live through a cycle and know how it's going to work out. You really do have to have substantial amount of money in the market to feel the pain when it goes down, to feel the euphoria, and kind of get in contact with your emotions. Are they similar to there? Are they different? And this is very different. When we hit a bubble, and we are in the beginning of the forming of one, there's almost no doubt in my mind that we're in the beginning of forming one. I do think it's a couple of years away, if not a little bit more. But it will be a way of life. It will be a mania, and it will seem idiotic not to be in these sectors. There's still $7 trillion sitting in cash on the sidelines. That's not going to be the case at the top of the market when things are so overvalued. I do believe firmly, just like we did in the 90s with broadband cables and whatever, just like we did with mortgages in the housing bubble in 07 leading into the 08 financial crisis. I do think Wall Street's going to fuel it. They're going to fund it with loans and stuff, but we are going to overbuild, or the system is going to overbuild in terms of all this data center and memory capacity, energy that has to run it all. There's no doubt in my mind that at some point near the top, we're going to overbuild this thing. We're going to have way too much infrastructure beyond the demand. But like the internet and the bubble that popped in the 90s, the late 90s going into the 2000s, you have to separate the trend that the internet was not going to stop. It's been building ever since, and cell phones and communications. But the market did pop down, but the build out kept going, and then the market would eventually catch up. We'll see the same thing. What's going on now with this whole next generation of artificial intelligence, it's going to go for pretty much the rest of my life, but the next 20 and plus years at least. We won't recognize the world in 10 or 15 years from what it is today, the conveniences that are going to be around. But we do think in the shorter term, within the next 5 years, they will overbuild it. The system will have to correct itself. There'll be a massive crash that basically wipes out some of these companies that are getting built just on speculation. But I do believe that all of these companies have to be spending this money right now. They don't have a choice. Best analogy I can give you is that if you race cars on NASCAR and you're running a basic engine that for years has gone 200 miles an hour, and all of a sudden somebody invents a very legal engine that goes 500 miles an hour, you're either going to have to buy that engine, invest in that capital, or get out of the racing business because you won't be able to catch up. That's what's happening with artificial intelligence and quantum computing and computing power. It's moving to a whole nother zip code, and all of these companies have to invest. Whether they're going to be around in 5 or more years, many of them aren't. And that's your investor, your investment manager, et cetera. It's their job to filter out, the good from the bad. But for the next couple of years, everything is going to, the rising tide raises all boats. So that's it for today. Like I said, 5% correction in the next couple of weeks. We hope. If we don't get it, hey, it just shows you how strong this thing is, and then a rip up higher into the end of the year. And with that, we'll let you be. Remember, this isn't investment advice. We're just giving you our thoughts on what's going on out there. Talk to your financial advisor if you want to act on any of this stuff. When you see something like this, we just really hope you know that that's the beginning of doing your own research. So that being said, we wish you a great rest of the week and a great weekend. Talk to you soon. Bye.